Okay, now we're going to see how it's actually done using the real statement cash flow of the company. We begin with the sign pattern analysis. To identify the company, financial or cash flow condition. We start with the operating cash flow. We take the net number, the net amount, operating cash flow. We also need to have this investing cash flow. We take the net amount. And finally, the FCF financing cash flow, the net amount. We're interested only the sign of the net amount of each section: operations, investing, and financing. So we scroll it up, we see the operating cash flow, line 46. For the year 2023, it is positive number. So here we write operating cash flow. The number is positive. And then for ICF, scroll it up. You see the investing section, which begins from row 56. You look at the net line, line 77. The number is in brackets, and that means in accounting negative number. So the sign is negative for ICF. Take it here. We write it negative. And the FCF section, you go down to the FCFF section, financing activity section, and the number is a positive number, plus 18. We are not interested now the number, we only want the sign. That's why it's called sign pattern analysis. It is a positive number. This is for the year 2023. We get positive, negative, positive. When you compare it to the table, you have the table in the presentation, we conclude that this company is type number 3, type 3 company. What does that mean? Type 3 company is a company with a profitable business. It generates positive cash flow from its business, but it's also a growing company, and the amount of money needed to finance the investments or the growth is more than the amount of money generated internally. So the company also uses external financing. Positive means cash inflow, negative means cash outflow. So the company is using both internally generated cash and externally generated cash to cover its investments. So it's a growing company. That is type number 3. Now we come to the second part, which is how to calculate the FCFF and the FCFE. FCFF equals to operating cash flow minus investing cash flow. We need to have these two numbers. Operating cash flow, we take the negative amount, the net amount, and I'm showing you here for the year 2023. Now we copy the number from the operating cash flow, equal. Operating cash flow for this year is this number, row number 46, 40 billion. That's internally generated cash. We can ignore the decimal numbers. Second is the investing cash flow amount. This also should be the net amount. This is equal to, go down to the investing section, which begins from row number 56. We take the net amount, 72 billion. The difference is the FCFF. OCF minus ICF. Now the minus is already there if I write another minus, the computer will turn it or change it to positive. Minus into minus is positive. So what I'm going to do is, this is the operating cash flow. Instead of minus, I use positive. So positive into negative is negative. So we get 27 billion negative number, meaning there is no money, there is no free cash flow. The amount of investment is larger than the amount of operating cash flow. From that number, we see that the company will require external financing. Now we want to know how the company was able to pay dividend, even though it has a negative free cash flow of the firm. Let's see the FCFE amount. FCFE shows money available for the shareholders of the company. You may recall the formula FCFE equals to cash available for all investors less net cash flow to lenders. We have to pay by contract the lenders first. So any money left after paying the lenders would be available for the shareholders, owners of the company. Now we begin with first step one. Step one is to calculate the cash available for distribution. Cash available equals to the FCFF plus any extraordinary gain minus any extraordinary loss. Extraordinary here means gain or loss not related to the business of the company, or any gain or loss that is not under the control of the management, like the movement of exchange rate. Now, we have already computed the FCFF, so we just copy the number from there. This is the FCFF. And then we add that number to any extraordinary gain, and then less any extraordinary loss. Now we can find or get these numbers from the statement of cash flow. Say equal, you scroll it up, you go down to the last section of the statement of cash flow, you look for the term effect of exchange rate. It's on row number 107. The number is negative, which means loss. Since there is no gain, we enter 0. There is no gain in that year. It's 0, no extra gain in that year. We search for the extraordinary loss. The same section, the last section of the statement of cash flow, on row number 107, you have the extraordinary loss. It's written as the effect of exchange rate change on cash and cash equivalent. The number is negative, so it's extraordinary loss. That will give us the cash available. Now we can compute the cash available equals to FCFF plus, I'm using the plus sign because the number is already negative. Negative plus negative will give us the total loss or total number. The computer will add. So we have 27,933 billion cash deficit, not available. Since the number is negative, there is no actually cash available. Meaning the company for the year 2023 actually was not able to pay dividend. However, it has actually paid dividend. How it paid the dividend is, it had cash balance. It used the cash savings of the company to pay the shareholders dividends. Now, with the cash balance, with the cash available, in this case it's cash deficit, we can easily calculate the FCFE following the formula. FCFE equals to cash available minus net cash flow to lenders. Now we have to separately calculate the net cash flow to lenders. That will include the interest income, interest paid to lenders, and debt repayment, plus any new loan. This will give us the interest paid to lenders, the debt repayment amount, and any new loans taken from the lenders will give us the total cash flow to lenders. And that's equal. All these numbers come from the statement of cash flow. So interest paid equals to, because we are talking about financing, we go straight to the financing section. And if you take a look at the interest line, row number 75, see the term interest received. Who received that amount is the lender. Interest paid or financing activity on row number 92, finance cost paid. That number is shown on the report as negative because the report is prepared from the perspective from the side of the company, so it is negative. The company paid. Who receives that money is the lenders. So we have to multiply that number by -1 to make it positive. We changed it to positive because we are making the calculations from the side of the lenders. On the report, it is negative because the company has paid. It's a cash outflow to the company, but it's a cash inflow to the lenders. So we change it to positive. Now we move to the debt repayment. Debt repayments by the company will be recorded as negative numbers in the financing section, but we are going to change to positive because they are all paid to the lenders. Since we are doing the calculation from the lender's perspective, we have to change it into cash inflow. So we say equal. We go to the financing activity. The first item is row number 80, proceed from exercise of share. That's related to the equity. You see the word share, so we don't take that number. You go to row 82, increase or decrease in short-term loan. The number is positive, that is new loan. We will take only the negative numbers that come with the words debt. The first item is on row 85, repayment of long-term loans. We take the number on row 85, repayment of long-term loans, and then we add that number. On row 86, repayment of long-term loans, plus payment of lease liabilities, plus redemption of debentures. These are all negative numbers which indicate debt repayment. The last item we have to add is coupon payment on subordinated debentures. These all numbers are negative. Since we are doing the calculation from the perspective of the company, from the lender side, to change to positive, we have to multiply the total amount by -1. And the reason for changing the sign is, again, we are looking things from the perspective of the owner, from the lender side. Now we come to any new loan taken from the lenders. We say equal. Again, we go to the financing section, financing activities section. We take the number. Only now we select positive numbers that come with the loan. The first item is row number 92, plus proceeds from short-term loan, row number 60, row number 83, plus Proceeds from long-term loan plus debentures, that's row 89. These are the numbers we have to take. The other numbers are related to shares. All these numbers are positive, it meaning the company has borrowed. We have to change them to negative because they borrowed from the lender. Lender has paid, it's a cash outflow to the lender. We multiply by -1, so it becomes negative number. And then we calculate the total amount equal interest received or paid to the lenders plus debt repayment plus the new loan is negative, so I use plus. If I change to minus, then the computer will add them together, so we get 21 billion. Actually, lenders, the company has taken money from the lenders. It's minus, meaning cash outflow from the lenders. With that number, we can now calculate the FCFE, which is the cash available plus the cash flow to the lenders. You get the total amount, FCFE, interest paid, plus the debt repayment, plus the new loans. You get the total amount, FCFE equals to cash available plus cash flow to the lenders. It's also 43 negative billion. So I have shown you already how to use the statement of cash flow to identify the sign pattern of the company, to compute the FCFF of the company and the FCFE. And that brings us to the end of session 3, which was about the analysis and evaluation of the statement of cash flow. Cash flow provides an important information to the current investors and potential investors. It shows the company's ability to repay or pay cash to the investors and the liquidity of the company. Thank you very much.